Hello and welcome back to the show. Welcome to episode 3 of World Wild Economy, where we're going to be talking about the continuation of the WallStreetBets saga, specifically where the subreddit might go from here in terms of as a community, but at the same time, it's money. We're also going to be talking about the kind of less loud and noticeable tectonic shifts in financial markets that have happened over the past week, specifically the first week or also the last week of January in trading and in financial markets. And we're also going to be talking about how essentially WallStreetBets and Robinhood fared with all that has been happening. And we're also going to touch upon retail kind of trying its hand at a silver squeeze and whether or not that was successful in any way. First of all, I will be talking about GME and whether it really did go to the moon. I have up on the screen a chart of GME. You can search this up yourself as well if you're listening to the audio version of the podcast. And the only residue, I'd say, of GME going to the moon, okay, obviously it going to $500 was very much noticeable and very much something to remember. Now the only residue is the way it looks as on the chart as a graph, and that is, it replicates an M. And this kind of collapse, which we've seen since that kind of rise, stratospheric rise, really has resulted from some of the buying pressure, or most of the buying pressure that really helped fuel that initial surge. It lessened. When you're looking at like short interest, trading volumes, it all pointed to essentially the price falling down as it did. And specifically, when you do look at the short interest, traders have essentially been covering their bearish bets because whereas the short interest was over 100% initially, one of the kind of propellants for this short squeeze, it is now, as of the 7th of February, less than 50%. Which is, like I said, down from more than 140% last month, according to data from S3 Partners. And it is quite insane to see how the price could fall so much as alongside the short interest falling as well. And this kind of points to the question, what happens to WallStreetBets? What happens to their kind of the situation they've created with GME and other stocks? And, it begs the question, how exactly can a short interest fall alongside a falling stock price? You're assuming that if these short bettors are kind of covering their bets, closing their positions, the price should pop up. It did obviously pop up after the first rise back to about $320 bucks a share. But nevertheless, it wasn't anything close to some people were predicting or hoping for. And when I say some people, I mean WallStreetBets Redditors specifically. And some of the reasons behind that might be obviously the impediments of the trading halts, or specifically the prevention of buying certain shares alongside namely GME, GameStop, buy firms, buy brokers such as Robinhood, and there was a few others. There was also the kind of WallStreetBets fire, this kind of energy that they had, it definitely died out, definitely very much quickly than most people probably suppose. And this was essentially because initially everyone was excited. There was a lot of hype, a lot of money to be made. The price was shooting up. You would see this on the news everywhere. But soon enough, the weekend hit, trading stopped, and people sat at home kind of thinking over their decisions. I think that's what kind of it came down to. And for the people that, kind of realized this sooner, they sold into the rally, they made some money, the rest got screwed over. And what's happening with WallStreetBets, or what happened with WallStreetBets, is a very interesting phenomenon, because you have to look at it from the perspective of through the lens that allows you to kind of see how millions, hundreds of thousands of these subreddit. Currently, the subreddit has 8.5, I think even more users, 8.5 million or so users. So you're looking at a few million people buying, selling, cooperating to a certain extent, and you have to ask yourself, what in the hell actually enabled that to happen? What drove these people to not only cooperate as one group, as one being, but also just kind of allow their money to be burned, whether that's $600, $100, $1,000, $10,000, whatever it could have been. I think it comes down to a belief in a certain fiction. I think WallStreetBets acted almost like a religious cult. It acted like a kind of radicalized youth, the same way you would suppose terrorists to act. It's ridiculous. And I'll give my arguments now, because these are it can be inflammatory rhetoric perceived as. Specifically, the feat of having so many people cooperate requires them to believe in a certain idea, a certain, fiction. Not to say that a religion or a cause is fiction, just in the belief of a story, in the belief, sorry, of a narrative. And what that allows them essentially to do is die for its cause, lose money for its cause. The fiction here, this kind of religion of sticking it to the man, anti-Wall Street rhetoric, is what people stuck behind and bought this stock relentlessly, not just at 40, 80, but 100 and 500 bucks a share, when it is worth, it doesn't matter how much it's worth. It's just the fact that, some people sold into the rally, a lot of people lost their money. And then the second thing here is that, in particular to the radicalization part of what I said, is that these people came in willing to lose their money. They wanted to stick it to their man. It was about sending a message, right? That was kind of the popular story that these people were pushing. If you look at the subreddit, people were stating their resentment for the hedge funds, for the financial crisis, for this, that, and the other, for hedge funds being bailed out, even though I'm not sure if any hedge funds did get bailed out in the 08, 09, 07, 08 crash, that whole time period. Obviously, there were bailouts and there was the whole ordeal of fiscal and monetary stimulus, but perhaps this was somewhat mistargeted, ill intent on the part of WallStreetBets redditors. But anyways, the point is that these people came here to send a message, not to make money by investing in capital markets. They were willing to lose their money, and well, so they did, right? And that is very similar to the idea of sending a message, to going for a greater cause, a cause greater than yourself, whilst being willing to lose something, in this case, money. And so, it kind of makes you then beg the question. It's like, okay, what happens with the subreddit now, the money and the actual community, which is what I said at the beginning. The money point is going to kind of touch into the short squeeze, or attempted short squeeze of silver, and the kind of retail money into silver. But actually, what we can see now is, as I show on the next picture here, actually a touch of activist investing. It's a topic that's been passed around. It's the belief that a community like this, with this kind of force, with this level of cooperation, and to a certain extent as well, kind of just strengthen the markets, right? They've got the money, they've got the funds, they've got the ability to cause havoc in small caps and smaller markets, kind of exploit some bottleneck problems. But anyways, what I have on the screen here is General Electric's Larry Culp cites pandemic sacrifice to defend $47 million bonus. And what does this have in relation to WallStreetBets? Well, essentially, the idea behind the GE CEO getting a certain large bonus, obviously, is the idea that this bonus would get unlocked in 2024 if GE stock traded above 10 bucks for at least 30 days, rather than, as a side note, the original $19 target. And on top of that, Mr. Culp, the GE CEO, could actually receive a bonus of up to $230 million if GE's shares traded about $16.68 for a sustained period, rather than the initial $31 target in his 2018 contract. And okay, the potential for this group is to fight for social causes, to do something in terms of a cause, again, a message, something to do with ESG, something to do with this abhorrent, to some person's opinion, bonuses to the GE, for example, CEO, and the problematic nature that this has in the kind of larger context of wealth inequality, and how boards and the CEOs potentially just drench business of their money. Right, so the potential for WallStreetBets here actually is to drive stock prices, for example, of GE lower down, to prevent that trigger point whereby the GE CEO would actually receive this bonus, right? If they deem his performance to be inadequate or whatever, or be against, like I said, this in a greater context, that is a potential to them, right? There's a potential for, again, like I said, the selling of a certain stock like GE, for example, because you need to ask yourself, for example, how can one expect or have faith in a company when the goal of the management is to, for example, loot the company, right? Because the message of getting a $47 million bonus, potentially a $230 million bonus, is that GE is being looted. It's no longer for real in terms of, for profit, for long-term sustainability. These are some of the problems. Again, I'm kind of spitballing ideas here. Very interesting topic, but we'll only see how this is going to evolve. The problem here with the activist investing kind of route and argument is that for someone who knows what WallStreetBets was a month ago, 2 months ago, 5 months, a year ago, before all of this mania over the past few weeks. Activism, social justice, whatever you might want to call it, doesn't really fit their portfolio. Like I said in last week's podcast, this is a place where people go to burn their money, high risk, high reward options trading, very edgy humor, and some crazy idiots and individuals. So this doesn't fit the narrative of what WallStreetBets used to be, but at the same time, to what extent has it not changed entirely? With an inflow of now near, I think, 7 million actually new subredditors, or subreddit redditors, WallStreetBets redditors, right? And the second thing, or kind of in addition to that, what WallStreetBets might become is, on top of its kind of influence in the community, as a community in the markets, it might also become a worthy sentiment tracker. So the same way people might track Twitter sentiment, Google sentiment, Facebook sentiment, some sort of sentiment, maybe WallStreetBets is those sentiment of WallStreetBets is one that will need to be tracked in the future. That is, again, an interesting question. But now, as opposed to what WallStreetBets will become as a community, we're going to quickly touch upon the silver squeeze and essentially where the money from potential WallStreetBets went. The idea here is that WallStreetBets and retail at large had shifted money from some of these stocks to silver. There were some posts on WallStreetBets specifically urging to do this, urging people to get into the silver short squeeze, because some big banks had short positions on, I think, paper silver in terms of the futures. I'll touch on that later on, because that is to a certain extent bonkers, the argument. But there was also said that actually the posts that were being made about silver on the WallStreetBets subreddit were a bit more of a smokescreen to get money driven from GameStop and these other stocks, which were causing a pain in Melvin Capital and other hedge funds potentially, to assets like silver. Nevertheless, in silver, we saw the retail Reddit crowd kind of, again, making its presence felt through the kind of mass arrival into the silver asset. Specifically, futures prices jumped as high as 13% to $30 on Monday morning this past week, which was the highest since February 2013. And this, activity, as we see on the screen as well, can be kind of perceived as quite frenzied. The silver demand and the demand for silver comes from investor demand and industry demand, and to a certain extent, they might be kind of correlated. As investors, suppose or forecast greater industry demand, they also might put their money in there. Or alternatively, investors might see the incredible monetary stimulus, monetary policy and fiscal stimulus coming to the shores of the economy, and might pack into silver, industrial metals, or commodities, or gold in terms of, for example, safe haven asset. Nevertheless, trading volumes in the iShares Silver Trust ETF SLV were nearly double last week's peak turnover in terms of the week before last week, and they were more than 7 times its average. So when we see on the graph here as well that this is showing the silver futures, the exchange, which the source comes from COMEX, the exchange raised margins on COMEX silver futures by 18% to 16,500 per contract. And so essentially what we saw is not only the actual price of silver spiking, but the premium paid for silver and paper, physical and paper silver also spiked, because especially since a lot of this hype came over the weekend. If you look at other podcasts, for example, the Peter Schiff's podcast, he owns a business which handles gold and silver. So what he does is he buys from wholesalers and then sells to retail, silver specifically, that I'm talking about. And over the weekend, when a lot of these orders came, silver, physical silver especially, isn't something that you can print more of or create more of very quickly in an instant manner. And so people have to pay higher premiums over the spot to secure a certain silver or, a certain asset related to silver. And so this is what we saw in terms of silver futures as well, specifically the actual influx of new silver buyers and orders actually took a serious toll on the supply picture. Like I said, when the premiums rise a lot, that showcases a large stress on essentially the silver supply picture. Zero Hedge actually reported that the premium for physical silver skyrocketed to $14 an ounce at the beginning of the week when silver peaked as well. I think that was on Monday specifically. And for context, we usually see actually these premiums sit between $2 to $4 an ounce, while the previous high water mark for physical silver premiums over the past kind of 5 years was less than $4 an ounce. And so when you're looking at a even paper silver price of peaking at $30, a $14 per ounce premium is insane. And the problem with that from an investor's point of view is that this can seriously wipe out your upside potential in the long term for silver, because silver, although it has spikes and can move rapidly and quickly and can have these wild swings, paying a premium of $14 might wipe out your gains for the foreseeable future in terms of years, because you paid for this a high premium in a frenzy and screwed yourself over with a lack of knowledge of the silver market, right, and how it operates. Just when you're looking at it at this kind of big picture perspective, right? So I also have a second graph here, which relates to silver ETFs and inflows specifically. So when I talked about silver futures and silver contracts for silver futures contracts and also physical silver purchases, the SLV, the Silver Trust, iShares Silver Trust, had its 3 record days in its history on Monday, which was number 1 on record. I think Thursday was number 2, and then Friday was number 3. So really, you had insane levels of money coming into these silver trusts, which is, again, historic. It's good for them. But at the same time, when you're looking at the potential for a short squeeze or any other, it is completely misguided in terms of how the silver market works, specifically how big it is. What enabled GameStop to shoot up so rapidly was the idea that it was a small cap. There was 50 million shares in public float, not all of which was trading hands day to day. So there was, realistically, let's say 20, 30, 40 million, whatever that number specifically was, 17 million, maybe less. That's something that I heard. The trading volume was much lower than the public float. And so when you cause a massive inflow of funds into the market, for GameStop shares, you see that price spike incredibly. But with silver, this market is a lot more. It's a lot more deeper essentially than is GameStop. It's more international. It is an industrial metal as much as it is an investor's asset, and therefore it isn't as easy to spike. Even though it did spike 10% on Monday, it isn't easy to nowhere near the multi-thousand price spike of GME. It therefore isn't as easy to simply manipulate the price or spike the price of such an asset as is a small cap stock. What I did also want to mention is the kind of intention and motivation that some people had, specifically WallStreetBets Redditors, when it came to attacking silver next. The motivation here lied in the idea that banks, I think Goldman Sachs was mentioned, banks are shorting silver futures, I believe it is. And the problem here is that some people's perception of that is that, okay, these banks are trying to, plummet the price. They're trying to get the price of silver, get them back for it, fuck them, whatever. That's completely misguided based on the fact that, especially when you look at brokerages and people who are short silver futures, it is usually used as a hedge to the silver positions and inventory that they have currently in stock. So when brokerages obviously buy, sell, handle, kind of transfer silver across hands, across buyers and sellers, they take on some of the risks of silver and its price. And to hedge against that, they can, for example, short silver futures, right? Or, buy and sell silver futures as they see fit. But the idea here is that silver futures, to short them isn't to kind of try and plummet and crush the market of silver. It is used as a hedge tool as opposed to what Melvin perhaps might have done with the short interest and the shorting of GameStop. It's completely two completely different mechanics. And again, it comes at the kind of it is because of the misconception that some amateur traders might have had on the silver market. And it's not to say that I know all of it and I can prove them wrong, but it is just a kind of another crumb of truth that they missed, piece of the puzzle when it came to silver and the market. And it's imperative to know how it operates to try and take advantage of it, or at least not to put yourself in a hole, dig yourself a hole. Because if you bought at the beginning of Monday, if you bought silver at the beginning of Monday, market opens and you open, you would have lost money by the time the market closed on Monday. So if you bought and sold at the beginning and then the end of the day, respectively, you would have lost money. Add to that the crazy, stupid premium that you're paying, and you're an idiot, right? You're not just losing money, you're an idiot. And that's poor outcome for some individuals. Nevertheless, it's the reality of the silver market and the reality of the of the markets which have such depth, such an international reach, as opposed to GameStop and a kind of small cap surprise, taken by surprise environment. But that's it, and that's that. That finishes the 20-minute section on Wall Street Bets, where the money went, where the community might go. Now I'm going to kind of switch to Robinhood. There's no more slides left, but I'll keep on the GameStop going to the moon. I think that is quite funny. Nevertheless, I'm going to now quickly cover what happened to Robinhood, and especially on the Thursday, which they halted trading. Why did they halt trading? Well, I talked about this in last week's podcast. I also made a separate video on. I made a clip of that and put that on my YouTube. So if you want to check that out, it's just a few minutes explaining specifically why brokerages halted trading in clear, succinct form, what caused their cost base to go up and essentially pose a liquidity problem to these brokerages, which therefore caused them to commit to a trading halt. Nevertheless, I'll quickly go over that again. Specifically, Robinhood chief executive Vlad Tenev announced on late Sunday that its equities clearinghouse had actually asked for $3 billion of margin deposits overnight on the Thursday. Right, that's during the week on the Thursday of the chaotic trading, specifically as it pertains to GME. And he then negotiated it and lowered it to a sum of 700 million. But nevertheless, in a nutshell, what the brokerage such as Robinhood does is that it facilitates the trades, right? It essentially gets the orders, it gets the transactions that people do, and then hands them over to essentially the clearinghouse. And what the problem with these orders is that it takes 2 days for these trades to clear through the clearinghouse. And across these 2 days, Robinhood must post collateral with the clearinghouse in the meantime, right? So even though, for example, Robinhood might facilitate the trade of someone buying GameStop at 100 and selling at 400, and another person buying that at 400 and selling it at 100, if both of these trades, essentially Robinhood has to post collateral for both of these trades. But even if both of these trades actually happen on Robinhood, so Robinhood is in a net zero position, Robinhood still has to post collateral, post liquidity, post its reserves, which it has or it doesn't have, to the clearinghouse for the 2 days. And that is based on the system of essentially how the clearinghouses worked. It causes some inefficiency in terms of having to post liquidity and reserve requirements, even though Robinhood might not lose any money from these trades. But what happens is that when the GME activity spiked, its price volatility spiked, the clearinghouses required more margin deposits, right? And so, especially when people trade on margin, there is the problem of the clearinghouses, again, like I said, requiring more margin deposits, which Robinhood might not have had, and well, they did not have, because on Thursday of the trading halt, there was $500 million gained from early investors and another extra $500 million taken from credit lines. So $1 billion was taken by Robinhood on the trading day, on the day of the trading halt, when GME shares were no longer being able to be bought on Robinhood alongside some other shares. $1 billion in extra liquidity to satisfy that liquidity requirement. And over the weekend, you had the whole dilemma of seriously Robinhood needing extra liquidity, right? Because otherwise they're going to go out of business. And the fear was that if Robinhood goes out of business, orders are lost and there's a whole potential equity market crash. Nevertheless, throughout the weekend, investors added to it 2.4 extra billion US dollars, equating to $3.4 billion US dollars in extra capital for Robinhood to satisfy the margin deposits which the clearinghouses required, as well as essentially facilitating the further on trade, the following week, for GameStop, because this wasn't going to stop. And obviously it didn't, but it did calm down to a certain extent. As we know, Robinhood did, like I said, negotiate the margin deposits. down from $3 billion US by the clearinghouse to $700 million US after the company specifically limited trading or buying in certain stocks. And so the question here is, if the clearinghouses didn't take 2 days to, for example, clear these orders, these trades, they didn't require that extensive liquidity and reserves. Because of that, would Robinhood have to have actually stopped trading at all? Maybe not, because a lot of the problem that came was that clearinghouses, because of the volatility and the GameStop purchases and selling, required a lot more liquidity and reserves from Robinhood. Robinhood had to post that, even though they might not have been losing money. Or maybe yes, maybe no. But the idea was that they definitely couldn't go on operating because of the liquidity requirement posed by the clearinghouses. Clearinghouse specifically. And so even in the scenario of being in a net zero position, as I mentioned about Robinhood, it doesn't take any margin to get yourself in a problem, because hey, you can be net zero, these two trades cancel each other out, you still have to put on liquidity. The margin then adds another kind of element, another layer of problematic reserve requirements for Robinhood and other brokerages. And so then the question kind of pertains to the trading halt, and what would it have happened if not for the reserve requirements, if not for essentially Robinhood's cost having to go in the kind of 2-day period specifically. Okay, like liquidity requirement, one thing, but also 2 days to process these orders at the clearinghouse. Even blockchain, I believe it solves potentially the issue of the clearing as it pertains to instant clearing. It potentially allows you to have the technology to clear instantly, or at least much more quickly than 2 days, right? Why does it take 2 days to clear a trade in 2021? We don't know. But again, should there be the requirements? Should there be the regulations? At the same time, it potentially protects against frenzied trading. I mean, nevertheless, it still happened, right? When you look at the SEC, when you look at Robinhood, when you look at the regulators talking about protecting the retail trader, okay, protect them, because the only thing we've seen so far is, well, trading halts, is, well, the GME plummeting and retail traders losing out, not only because of the stock price and what had happened, but because they couldn't buy it anymore, because of the trading halts, right? Because of these liquidity requirements that, for example, Robinhood had to satisfy. But nevertheless, it kind of goes to show you, it's an interesting lesson to take from this, because Robinhood, it isn't as much a brokerage as is an interesting tech player in the field, right? It's on the West Coast, West Coast. Sorry. And it is primarily a tech company. It is, it calls itself a pioneer in its industry. But really what we've come to learn from the situation is that even as per the English folklore, from where Robinhood gets its name from, Robinhood, as we know, stole from the rich and gave to the poor, but he is still a thief. No, that's it, right? And as per the financial system, Robinhood wishes to be seen as an outsider, even a pioneer, as it said itself, but is nevertheless just one side of a trade. Liquidity requirements, reserve requirements, satisfying clients, customers. I talked about Robinhood's business model last week. That probably came as some big news to some people, and how the customer is not the people on Robinhood trading, but is Citadel and market makers. And Robinhood, all it does is sell the order flow of these traders, of these investors on its app to the bigger market makers, which front run the trade anyways. But that's where I'm going to end it on. If you want to check out more of my content, written, more macro, more monetary economics focused analysis, check out investingintellect.com. Otherwise, be sure to check out my other episodes, where I will be also not only live streaming every week, posting them on my podcast every week, and dissecting some of the issues which make our economy so wild, but at the same time, so entertaining. Every week, there's new things to learn, new things to talk about, and improve your commercial awareness. Thank you for sticking by. Have a great evening, day, whenever it is that you're listening. Goodbye.